Once again, my name is Brian Wilson. I'm part of our Market Structure Edge team. You'll see me writing notes once in a while. Henry is also on the call today. He's part of our team. He's going to be kind of in the background, helping me to steer things, and if there's questions, helping to address some of the questions. For those who are new to the call, just a couple of ground rules. Please just keep your mics muted if you would, just so there's not background noise. But please, if you have questions as we go along, we would love to hear your questions, and we'll try to get to them all. So with today's meeting itself, I wanted to do a little bit of, let's call it educational material at the beginning, maybe 5 or 10 minutes. We'll try to keep it, let's call it an airplane flying at about 30,000 feet. So we'll try to keep it high level, but I think there's some things that perhaps even some of you veterans might have a feeling, is what's happening, but perhaps you're not aware of the magnitude, and you'll understand what I mean here when I get to my slides. So we're going to start by looking at trying to address the question why trading can be so short-term in nature. For those of you who are aware of trading dynamics, boy, sometimes it seems like trading can go, something can be in play for a couple of days, and then the trend will change. What's happening from a broad market perspective? This is a slide deck that we actually work with when we're working with investor relations teams. That's the other side of our business, and what we're trying to help them understand, and I think perhaps it's just good information for you to know, is why is the market so different than it used to be? I'm a former buy-side trader. I worked in that role for about 10 years. I was with a growth company. And this is the world that I was used to in the late 90s / early 2000s. So in other words, if something was moving in the marketplace, there was basically about an 80% chance that it was active investors making that move. Well, we wake up to the world today, and it's basically like you've woken up on a different planet. This is the amount of active investors on a daily basis, and our data supports this over a very long time frame, that active investors tend to be about 9 to 10% of daily trading activity. Machines, think about high frequency trading strategies, day trading strategies, that type, high frequency strategies, that type of activity. 3% of trading. Passive money, think about index funds, ETFs, quant funds. They're trading according to certain characteristics criteria. That's about 20%, and the risk management component is about 17%. I bring this data up. You can see once it is dramatically different. If a stock is moving today, there's about a 10% chance that the primary influence is from active investors. Otherwise, it's other strategies in the marketplace that are moving those shares. So once again, 30,000 foot view, just wanted to give you a feel for what the market actually looks like today versus what the market looked like 20, 25 years ago. That being said, I'll move into right now our risk management component. We're in the middle of expirations right now, options expiration cycle. It occurs every month. It's important for a few reasons. One of the reasons is derivative strategies are such a huge part of the market. I'm going to share with you just a slide and then go to what the current situation looks like. So this is from the Bank for International Settlements, and I wanted to show you what's happening from a risk management perspective. You hear us talk about that. You hear us talk about options expirations. Why do we talk about it? Why do we think it's important? Second half of 2019, over $550 trillion of national value derivatives. Now, from equity-linked contracts, such as forwards and swaps and options, that number was about 6.8 trillion, once again, second half of 2019. Let's fast forward to today, or second half of 2022, same data, all contracts is now north of 600 trillion. So, moving from 550 to 600 in just a couple of years. And if we look at those equity-linked contracts, staying about the same amount, about $6.9 trillion. So when we come into options expirations itself, this is the magnitude of what we're talking about. And I used an example this morning, and I'll shift back to that example here as we discuss expirations for a second. When you think about expirations related trading, market participants have a decision to make. And I used the example this morning of your car insurance bill coming due. So that insurance bill comes due. What do you want to do? And I've had teenage drivers, and I've had to make this decision. That bill comes in, it's too expensive. What do I do then? Do I go ahead and keep the same parameters of that contract, accepting the fact that I'm going to shell out a few more dollars? Do I make changes to that contract? Do I reduce some of my spend? Do I add to it? So that's some of the decisions during expirations in terms of rolling existing contracts. What do those contracts look like right now? Are hedges becoming more expensive in the marketplace? Like I said, rolling exactly what you have right now, adding to some positions. Maybe you're hedged a little bit. Do you want to add to some of those hedges? Or do you just want to drop them? When I have had my car insurance, using that example, well, it got too expensive. What can I do to save some money? I drop some of my coverage. So that's one way that I like to think about options expirations. What do market participants, traders, and investors, what do they want to do with their insurance when it's coming due? I think we had. Thank you, TJ. We'll talk about that here. So risk management derivatives. Is market volume affected by the buying? Really all of the above. So we're talking about options, we're talking about forwards, we're talking about swaps. And one of the things that I like about the way that we're able to measure risk management trading is we're able to look at not only the listed activity, but we're also able to look at the over-the-counter activity. How are we able to do that? Well, we measure what the big counterparties are doing in the marketplace. So let's say that I'm a huge institutional investor, and I've gotten very bullish, and I've bought a lot of call contracts. Well, my broker, let's say it's Goldman Sachs, their books can't be naked. They need to balance their books. So what they would then do, they would go out into the marketplace, they would buy shares of that particular company, and they would likely be covering shorts at the same time. So as you measure that risk management activity, it gives you a feel for which way market participants are slanted. I'll give you an example. One of my customers on the IR side, we were coming up to earnings. We started to track risk management trading increasing ahead of earnings and short volumes going down. Well, what was happening? Well, they were getting some pre-earnings bullish bets. It's always a question of whether those bets will work or not, but we were able to track that data due to what was happening on the risk management side, due to what was happening with short volumes. We were able to let the customer know they were actually up 10% with earnings. You never know if those bets will work or not, but that was their setup ahead of earnings itself. Thank you for your question, TJ. Hopefully that addresses it. Looking at all activity, really both listed and over the counter, measuring it through what the big counterparties, the big banks and brokers are doing in the marketplace. So talked about that changing composition of market volume, how the world is very different from the world that, we were used to 20, 25 years ago, getting into some of those risk management strategies, why it's important, especially during expirations. Let me take you to Edge, and I just want to introduce this concept to you. It's another way of thinking about the data. We talk about how you can trade volatility. If you've stayed with us any amount of time, and let me give you an example of this. In the momentum portfolio today, we have FSLR. Normal volatility is about 4.4%. So according to that criteria, if shares are down more than 2.2%, well, it presents a pretty good buying opportunity. There's a very good chance, due to the setup that it has right now with, and let me show you the setup, due to strong demand and short volumes moving lower. Here's demand moving up, here's short volumes moving lower. There's a good chance that you can probably make some gains in that stock over the next 1 to 3 trading days. Now, of course, you have to factor in what's happening with the broad market, but those that are veterans understand that we'll look at that intraday volatility, and try to get potential trade setups that way. One area that I like to monitor as well, and I just introduced this as a different way of thinking about how you can use the data. Many of you are already doing this. I actually gave this example this morning with the utilities sector. Now, perhaps I came into this trade a little bit early. Let me enlarge this for you. But I started buying this a couple of days ago. Why did I start to buy it? Well, sentiment was starting to move higher. We were coming off of lows that were all the way down to 2.9. So when you're talking about an entire sector that's becoming very oversold, and meanwhile, short volumes were very, very low. Well, lower than they had been. Is this a perfect setup? No. If I was a little bit more patient with this trade, and it might still work out, but if I was a little bit more patient, I might wait for sentiment to move above neutral. And instead of short volumes being, 50%, maybe 47, 48% or what have you. I got an early start on the trade. It might still work out, but I just wanted to introduce you to the concept that as you watch on your dashboard, and each one of you, has these different portfolios, you can track different sectors and what they're doing. What I will also track, and I pointed this out to you guys the last time I was on this call, for many of the sectors, especially the ones that carry a little bit more weight, here's 2 of them: communication services, consumer discretionary. I'll pull up consumer discretionary here. I track the largest companies because sometimes what will happen from a large company perspective will happen to them first, and then everyone else will start to tag along. So this is just what's called a static portfolio. I take the largest ones, in this case in the consumer discretionary sector, and how I did that in terms of setting up this portfolio. I just ranked them by market cap and then set up a static portfolio accordingly. So what I wanted to show you here, if you were interested in like, oh, I wonder if consumer discretionary is about ready to move higher. Well, maybe. I say maybe because sentiment is basically moving sideways, but we're starting to get some pretty good short covering with those large companies. And ironically, if you look at the supply that we have for these companies, look at the ones that are really low right now. Do those names kind of ring a bell? They've all been in our low volatility portfolio here over the last week or so. So very low short volumes. They came into our portfolio. You would have been able to see them there. But just know that you can track these different sectors and different ways of looking at things. Wanted to show you one other sector today. So we looked at consumer discretionary, the big companies there, maybe starting to move lower a little bit. we're starting to get, and Henry and I were discussing this today, we're starting to get the opposite movement happening in big tech. Demand is not very good right now. So demand is weak and short volumes are moving high. So when you think about leadership in the market, a lot of times it will come, and once again, this is the components for big tech. We're looking at the top 8 components of the triple Q, plus AMD, Netflix, and Shopify. So right now we would say, boy, there's a little bit of a mixed, let's call it setup or mixed look when we think about possible, leadership from a tech perspective. Now, if you want to, trade sector activity, there's a lot of different ways that you can do that. If you want to get just and this is what I bought. This is the sector spiders, so SPDR. And this is exactly what I did the other day. I bought the utilities, XLU. It's just a regular leverage, and by that I mean it's just trying to track what the sector itself is doing. If you have a really strong conviction about a particular sector, and I actually did this about a week and a half or so ago, I bought a 2 times short on the materials sector. Now, recognize that when you do some of those leveraged plays, that those leverage plays tend to be very thin from a liquidity perspective. So sometimes it can be a little harder to get in or out. Sector spiders, at least according to my experience, tends to be a little bit safer way if you want to participate in that type of trade. So once again, I just wanted to introduce you to the concept that you can use edge for sector plays. Let me show you a different way that you can use edge. And this is actually from a broad market perspective. This is the S&P 500. And as you can see, when we got above 6, and our CEO, Tim Quast, had been talking about this here over the last weeks, you tend to have a reversion, wherever you enter above 6, the central tendency, and recognize that central tendencies are just that. They don't work all the time, but they're a central tendency for a reason. Central tendency is that the market will tend to revert back to those levels. So we zoomed higher late July. What did we eventually do? Well, we've reverted back to those levels. Think about a potential trade that you could make here. So if you were above the red line, and this is 6.0 from a sentiment perspective, once again, there's nothing special about that number. It's just what we've seen statistically over time, that the market gets, let's call it a little overextended when we get above those levels. So you get above those levels, maybe you sell a call. Maybe you trade knowing that over the next month or so, there's a good chance that the market is probably going to trend sideways or perhaps start to move a little bit lower. That would be your kind of observation from a market that gets above 6. But no, be aware that it's not going to happen immediately. And you see this play out over time. Let me back this look up for a second. And I think we can see it the last time that we moved above 6. If we have it on the radar, might have to move farther back. And if we don't have it to look at that, that's fine. Well, I mean, here's a good example. We moved above 6 in late March, early April. What did the market do? Trended sideways there for a little while. And once sentiment started to rise, then the market started to rise once more. So recognize that with the broad market itself, there's different ways that you can trade that. And one consideration, and you've heard Tim mention this, and I've mentioned it before as well. You can go long or short just the SPY. You can buy the SPY during periods when the market is probably going to be advancing. When would such periods be? Well, if you move below the green line, the market's getting oversold. There's a real good chance for advances in that type of environment. So you can buy the SPY, you can short the SPY, and similar to sector trading, you can get as leveraged as you like. Usually both directions. I like to go 2 times leverage. I think Henry is so drilled in with this trade that he actually goes 3 times leverage, if I'm not mistaken. So just know that you can play just looking at the data. You can trade just broad market moves, knowing what's inherently going to happen. Once again, these are central tendencies. So let me shift back here for a moment and see if I'm missing any questions. Pamela, did you have any further questions in terms of that? If there is, please just let me know. TJ, so J&J 87% supply with demand around 5. How can the supply be so high? Is it a good short? Let's go ahead and take a peek at that. Thanks for your answer, Pamela. So J&J, high supply, and is it a good short? Okay, let's go take a peek at that one. Okay, so you can see steady demand. And so demand has been right around neutral, and you can see that supply just increasing over time. For part of that move higher, with short volumes moving higher, share price was moving higher at the same time. So what that usually communicates is that recognize what short volumes are. They're a representation of borrowed shares in the marketplace. So sometimes when there is great demand for shares, market makers can't fulfill that just because of strained liquidity. So they borrow shares to facilitate some of that demand. Part of this move higher has that appearance to me. Now, 87% is an extremely high number. What I would look at personally, if I were going to short this, ideally, I'd want 2 things to be in play. I would want that demand to tick down. So in other words, demand moving lower, short volumes remaining high. And if possible, I would love it if J&J was actually higher on the day. So think of trading as like you're a hunter, right? You're hunting for those best opportunities. Well, if you're shorting the market, you're looking for those opportunities where J&J is a little extended, right? It's moving higher, and you see in the data, weak demand, high short volumes, central tendency says that should go lower. That's when I would be entering into that short trade if those parameters make sense. Let's talk for just a moment here. Thank you for your questions, TJ. Hopefully that addressed it. Let's move back to the broad market for a moment, and let's take a peek at what I'm calling kind of a messy bottom. And I mentioned this morning in the note, could there be another leg down? And I'm not trying to be evasive with this answer, but I don't know. The data, we're in one of those time frames right now. I think where we need to get a couple of more data points. Maybe that will come today and tomorrow as we make our way through the end of this expiration cycle. Here's why I don't know. The central tendency for a market down into expirations is it will usually move higher than afterwards. That's what usually happens, or vice versa. Up into expirations usually goes down then afterwards. Well, look at this market. We're not getting any clear signals. Sentiment has been pegged at 4.5 for 3 consecutive days. What is 4.5? Well, a little bit below neutral. We need a market above 5 to sustain gains in the market. Right now, we don't have that. Meanwhile, short volumes are high. They're above trend. In fact, if we back this look up, let's back it up to 6 months. that short volume, it's moving down ever so small increment, but that's still above trend. So we have a market right now that we don't know which direction it's going to go to from a demand perspective, and we have a market that has excess supply in it. Could this market falter from this point? Yes, it sure could. I can't make that call today. And honestly, I don't even know at the end of the day, if I could make a call on a trade. If I was buying the SPY or shorting it, I think I'm on the sidelines today because I don't know which direction that market goes from here. Hopefully that makes sense. I think we need a couple of more data points there, but I'm calling it a messy bottom for now. As we wait to see, really what comes next. Let me see if I'm missing any questions. I think I've got all the questions. Last part is, just a reminder, and we talked about this briefly. We're looking for divergences, and those who are veterans are very familiar with this. I'll show you two that I highlighted today. I haven't checked Costco recently. I believe it was down about 1.4% the last time I checked. I'm probably going to buy it at the end of the day if it's still down. So here's the Costco setup. Price has been doing well, sentiment neutral, so good from a demand perspective. Look at those short volumes really moving lower. Now, I probably placed this trade at the end of the day with a stop loss in place. Once again, knowing I'm in the middle of expirations, and sometimes you can have just weird things happen that are unexpected. It's the nature of expirations trading when you have $6.9 trillion of money making decisions, in regards to what they want to do next. It's hard to have a good read when there's that type of activity in the market itself. Let's go take a quick look at APH. That was the other one that was highlighted today, if I can find it. All right, APH. And once again, just, good supply demand. Demand is steady and short volumes are really coming in. So that's another one. And look at how low short volumes are, all the way down to 26%. So very, very low short volumes. One other way that you can think about it from a divergence perspective is that you can do that same type of activity, really with any stock that you want to. It doesn't have to be just stocks in the momentum or low volatility portfolios. I'll give you NVIDIA as an example. We're coming up on earnings here, thinking about a week or so. I've already seen some speculation around it. If you wanted to trade ahead of earnings, and that's another category of risk, I don't do it. But if you like to do that type of trade, it would behoove you to know the setup ahead of that trade itself. What's the setup right now? Well, demand is really weak. We have bottomed out at 1, which is not great, but also recognize, you can't go any lower. You're very, very oversold from that setup. And short volumes are below norm. I would not place that trade right now, but if you have a higher risk tolerance, know that, sentiment that has become very oversold. You have a good chance to get a nice bounce, especially when short volumes are low. It's just not as good of a setup as if you had demand that was 5 or greater. So that was really the main points I wanted to cover with you guys today. Just real quick recap. We talked about why the market is different, and happy to discuss this with any of you guys that has questions. We just wanted to do kind of a 30,000 foot view today. We took a look at why risk management matters in the marketplace. Looking at the trillions of dollars that are attached to that, 6.9 trillion from an equity contract perspective, even greater when we look at all contracts, which includes, foreign exchange and interest rate and such activity like that. We took a peek at sector trading and what you can do with that. What you can also do from a broad market perspective when you're trading the SPY, if you want to do that type of thing. And then lastly, just a reminder about diversions. Steve, how much impact do you think his short sale is? It's a good question. Can you tell me what he actually shorted? I didn't read that article.
He shorted all SPY and QQQ and NASDAQ 1.6 billion.
6 billion.
More than anything else, it's more than anything else. It's all the people who saw that he did it after the fortunes he made in the real estate.
Correct. Correct. Yeah. He's been right before. He's been wrong before. Could it be having an impact right now? Sure, it could. Especially from a headline perspective. Those headlines can certainly drive trading. Recognize though that when they do, a lot of times that's more fast trading and quantitative strategies that are going to latch on to that. And as such, they tend to be short-lived, if that makes sense.
I have another real quick question, and that is in regard to when you look at the only momentum stock that was on market structure today, FSLR and it is dropped. It's down almost 5%. Was down 5%, and 4.4 is a full volatility. Mm-hmm. And there's no bad news. How do you attribute that? There's no news at all about it.
Yeah. Quite simply, when you get that type of movement, always remember the context in the market and what's been happening. So for this particular setup, we have gains over the last week or so, fairly sizable gains, and then we have 2 down days. Where the down days come right into expirations itself. This hints quite simply at profit taking. A lot of times that is just as simple as hedge fund profit taking. They got rights to shares that were into the money ahead of expirations, and they're taking their profits. So that is part of the reason why expirations trading can be tricky. You have to keep in mind the context and why certain parties might be trading at that particular time. If you have a stock that has had a strong run, there's that inherent desire to take some money off the table.
Okay. Thank you.
MPC. Sure. Let's take a quick look at MPC, and then I think we're probably at the tail end of our time today. Very, very, very strong setup. Obviously, demand, pegged at 10 for the longest time. Very strong gains as well, and low short volumes. It's a strong setup. 2 things would give me pause on this trade. One is what I just mentioned. We're right in the middle of expirations. What's happened coming into expirations? We've already had profit taking. And 2, we've been at 10 for a very long time. The longer that you're at 10, and you can sometimes be at 10 for 2 or 3 weeks at a stretch. We'll see Tesla in the data that will have that type of trading from time to time. But just recognize the longer that you're at 10, the greater the proclivity to get some profit taking at some point in time. So I would hesitate to make this trade just because we're in the middle of expirations and the duration of time that we've been stretched at 10. I think, guys, that will do it for today. Thank you so much for your time. Hopefully today's session was helpful. I believe Tim will be back in play next week. Please forward any nasty comments, about today's session to him. He'll he'll take them all in stride. But great to see you guys. Hope you have just a wonderful rest of the day and Friday and weekend. As I mentioned at the beginning of the call, I am taking off tomorrow to drive my daughter to Omaha and then off to Michigan. So great stuff, guys. We will catch you later.
Appreciate it.
You're very welcome.